What I'm about to tell you could be the difference between preserving your wealth for the next generation and watching everything you've worked for evaporate in the next economic collapse. And I'm not being dramatic here. I'm being honest. I'm Kevin O'Leary. I built a software company and sold it for over $4 billion. I've been investing for 40 years across every asset class you can imagine. I've survived multiple recessions, market crashes, and currency crises. And what I'm seeing right now with the US dollar terrifies me more than anything I've witnessed in 4 decades of investing. Before I get into this, hit that subscribe button right now. Smash it. This channel is about protecting your wealth and making smart investment decisions. And if you're serious about financial survival in the coming years, you need to be part of this community. We're at a turning point, and the people who understand what's happening are going to be the only ones left standing. Here's the brutal truth that nobody wants to tell you. The US dollar is losing its dominance, and if you don't move your money out of dollar-denominated assets strategically, you're going to get crushed. Period. End of story. I'm going to tell you exactly what you should be doing instead. I'm going to share 4 specific asset classes that are going to protect you when the dollar weakens, and these are the same principles that have allowed me to preserve wealth through every single economic crisis I've ever faced. I meet people every single day who have their entire net worth sitting in US dollars, cash and savings accounts, bonds denominated in dollars, stocks priced in dollars, and you know what? They're terrified. They see inflation eating away at their purchasing power. They see global tensions rising. They hear about countries trying to move away from the dollar, but they don't know what to do about it. Let me explain something to you. The dollar's reserve currency status is not permanent. It's a privilege, not a birthright. And right now, that privilege is being challenged in ways we haven't seen since World War II. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create alternative payment systems. China is settling oil trades in yuan. Countries are diversifying their foreign reserves away from dollars at the fastest pace in 30 years. Do you know what happens when reserve currency status erodes? Look at the British pound after World War II. It lost 30% of its value in less than a decade. Entire fortunes were wiped out because people didn't see it coming. They thought Britain ruled the world for 200 years. The pound is safe. Wrong. The difference between protecting your wealth and losing half of it comes down to one thing: understanding that currencies compete, and right now, the dollar is losing market share. Now, I know what you're thinking, but Kevin, the dollar is the strongest currency in the world. The US economy is still the largest. This is just fear-mongering. Listen to me carefully. I'm not saying the dollar is going to zero tomorrow. I'm not saying we're becoming Venezuela. I'm saying that the dollar's purchasing power is being systematically destroyed by fiscal irresponsibility, and its dominance in global trade is being actively undermined by strategic competitors. I'm going to tell you exactly what you should be doing instead. Most financial advisors won't tell you this because they're trained to keep you in traditional dollar-based portfolios. They make money when you stay comfortable. But comfort is expensive. Comfort costs you returns. Comfort costs you security. The first thing you need to move your money into is gold and precious metals. Now, this is going to upset a lot of people, but I don't care. Gold has been money for 5,000 years. The dollar has been money for 50 years. Which one do you trust more? Let me explain something to you. Gold is the ultimate currency hedge because it has zero counterparty risk. When you hold physical gold, you don't need a government to honor its promise. You don't need a central bank to maintain discipline. You don't need anything except the intrinsic value that gold has maintained across every civilization in human history. That's power. Let me hit you with some numbers. Since 1971, when Nixon took the U.S. off the gold standard, gold has increased from $35 per ounce to over $2,000 per ounce. That's a 5,600% increase. Do you know what happened to the dollar's purchasing power during that same period? It lost 85%. A dollar in 1971 is worth 15 cents today. That's not inflation. That's currency destruction. And here's what kills me. Central banks around the world know this. They're buying gold at record levels. China bought over 225 tons of gold in the last year alone. Poland, Singapore, India, they're all stacking gold because they understand that when the global monetary system resets, gold is going to be the only universally accepted asset. Now, I can already hear the excuses. But Kevin, gold doesn't pay dividends. It just sits there. You're right. Gold doesn't pay you anything. You know what else doesn't pay you anything? Cash in your savings account earning 0.5%. while inflation runs at 4%. At least gold preserves purchasing power. At least gold can't be printed into oblivion by a desperate government. Poor people worry about yields. Rich people worry about preservation. Which one do you want to be? I recommend allocating 10–20% of your portfolio to physical gold and precious metals. Not gold ETFs, not mining stocks, physical gold that you can hold. And if you can't afford gold at $2,000 an ounce, buy silver. Silver is trading at historically cheap levels compared to gold. The gold to silver ratio is 80.1 when historically it's been closer to 50.1. That's an opportunity. And that brings me to the second asset class you need to own right now. The second thing you need to allocate to is Bitcoin and select digital assets. Now this is where I'm going to lose some of you old school investors, but stay with me because this is critical. Bitcoin is digital gold. It's a scarce asset with a fixed supply of 21 million coins that can never be changed. Unlike the dollar, which the Federal Reserve can print endlessly, Bitcoin has programmatic scarcity built into its code. You cannot inflate Bitcoin. That makes it the single best hedge against currency debasement we've ever seen in human history. Let me explain something to you. Every single Bitcoin transaction is recorded on a public ledger that cannot be altered. That means Bitcoin is more transparent than any government currency. It's more secure than any bank vault. And it's accessible to anyone with an internet connection, which means it's more democratic than any financial system we've ever built. Let me hit you with some numbers. Bitcoin has outperformed every single asset class over the last 10 years. Gold returned about 80%. The S&P 500 returned about 180%. Do you know what Bitcoin returned? Over 10,000%. I'm not saying that's going to happen again, but I am saying that the asset has proven itself as a legitimate store of value. And institutions agree. BlackRock launched a Bitcoin ETF. Fidelity offers Bitcoin custody. MicroStrategy has $5 billion worth of Bitcoin on its balance sheet. These aren't gamblers. These are sophisticated financial institutions that understand Bitcoin's value proposition. Here's what people miss. When the dollar weakens, people need somewhere to go. They need a non-sovereign, non-inflatable store of value. In the past, that was gold. Today, they have two options, gold and Bitcoin. And Bitcoin is easier to store, easier to transfer, and easier to verify than gold. That's why it's capturing market share. Now, I can already hear the pushback, but Kevin, Bitcoin is volatile. It crashed 70% in 2022. You're absolutely right. Bitcoin is volatile. You know what else is volatile? Your dollar is losing value every single day, just more slowly. At least with Bitcoin, the volatility goes in both directions. Your dollar only goes down. Poor people fear volatility. Rich people use volatility to acquire assets at discounts. Which one do you want to be? I recommend allocating 5 to 10% of your portfolio to Bitcoin. Not altcoins, not speculative crypto. Bitcoin. The digital asset with the longest track record, the strongest network security, and the clearest value proposition as digital gold. If this is making sense, smash that like button right now. Listen carefully to this next one because this is where most people get it completely wrong. The third asset class you need to own is foreign dividend-paying stocks in strong currency jurisdictions. This is critical, and most Americans completely ignore this strategy because they have home country bias. Let me tell you something. When you own U.S. stocks, you have two risks: the business risk of the company and the currency risk of the dollar. If the dollar weakens 20%, your stock could go up 20%, and you've made zero real progress in global purchasing power terms. You're running in place while your wealth erodes. But when you own stocks denominated in stronger currencies, Swiss francs, Singapore dollars, Norwegian kroner, you get paid in currencies that are backed by fiscal discipline, low debt to GDP ratios, and actual commodity exports. That's diversification that actually works. Let me hit you with some numbers. Switzerland has a debt to GDP ratio of 40%. The United States has a debt to GDP ratio of 123%. Norway has a $1.4 trillion sovereign wealth fund. The United States has $34 trillion in debt. Which country's currency would you rather be exposed to? This isn't complicated. And here's the beautiful part. You can own Swiss pharmaceutical companies like Roche or Novartis that pay 3 to 4% dividends in Swiss francs. You can own Singapore banks like DBS or OCBC that pay dividends in Singapore dollars, backed by one of the most well-managed economies in Asia. You can own Norwegian energy companies that pay dividends funded by actual oil production, not financial engineering. These companies generate cash flow in strong currencies. They pay dividends in strong currencies. And when the dollar weakens, the value of those dividends in dollar terms goes up. It's a built-in hedge that most people never think about. Now, I can already hear the objection. But Kevin, foreign stocks are harder to research. I don't understand those markets. That's an excuse, not a reason. You can buy international ETFs. You can hire advisors who specialize in foreign markets. The information is available if you're willing to look for it. Poor people stay comfortable with what they know. Rich people go where the opportunity is, even if it's uncomfortable. Which one do you want to be? I recommend allocating 15–25% of your equity portfolio to foreign dividend-paying stocks in strong currency jurisdictions. Focus on quality companies with long track records, sustainable dividends, and exposure to currencies backed by fiscal discipline. And this brings me to the fourth and final asset class that's absolutely critical. The fourth thing you need to own is productive real assets: farmland, energy infrastructure, water rights, timberland. These are assets that produce actual value independent of what any currency does. And in a world of currency instability, real assets are king. Let me explain something to you. When you own farmland, it produces food. People need food regardless of whether the dollar is strong or weak. When you own energy infrastructure like pipelines or renewable energy facilities, they produce energy. People need energy whether inflation is 2% or 10%. These assets generate real, tangible value that cannot be inflated away. Let me hit you with some numbers. Farmland has returned 11% annually over the last 30 years with lower volatility than stocks. Timberland has returned 9% annually. Infrastructure assets have returned 8 to 10% annually with inflation protection built in because most contracts have automatic price escalators tied to inflation indices. And here's what people miss. These assets are scarce. There's a finite amount of arable farmland. There's a finite amount of fresh water. There's a finite amount of energy infrastructure already built. As the global population grows and the middle class expands, demand for these resources increases, but supply cannot keep pace. That's the definition of a good investment. Bill Gates owns over 240,000 acres of farmland in the United States. Do you think that's an accident? Warren Buffett owns energy infrastructure through Berkshire Hathaway Energy. Michael Burry bought water rights in California. These people understand that when currencies fail, real assets are what protect wealth. Now, I can already hear you saying, "But Kevin, I don't have millions of dollars to buy a farm." You don't need millions. You can invest in farmland rights. You can invest in infrastructure ETFs. You can invest in timberland investment management organizations, TIMOs. The access exists if you're willing to find it. Poor people think real assets are only for billionaires. Rich people find ways to get exposure at any wealth level. Which one do you want to be? I recommend allocating 10–15% of your portfolio to productive real assets through REITs, ETFs, or direct ownership if you have the capital. Focus on assets that produce essential goods and services that maintain value regardless of currency fluctuations. These four asset classes, gold and precious metals, Bitcoin and digital assets, foreign dividend-paying stocks, and productive real assets, are your defense against dollar debasement. They're not speculative, they're strategic. So let me bring this all together for you. The dollar is losing its reserve currency status, central banks are diversifying away from it, inflation is eroding its purchasing power, and geopolitical competitors are actively building alternative systems. You need to protect yourself by moving into assets that preserve value independent of dollar strength. Gold and precious metals for zero counterparty risk and historical preservation of wealth, Bitcoin and digital assets for programmatic scarcity and non-sovereign storage of value, foreign dividend-paying stocks and strong currency jurisdictions for diversification and exposure to fiscal discipline, and productive real assets like farmland and infrastructure for tangible value creation that survives any currency regime. You have a choice. You can keep 100% of your wealth in dollar-denominated assets and hope that somehow magically the fiscal irresponsibility stops, the debt gets paid down, and America's global competitors decide to keep using dollars out of the goodness of their hearts. Or you can acknowledge reality, diversify strategically, and position yourself to preserve wealth regardless of what happens to the dollar. One path requires faith, the other path requires discipline. Here's what I want you to do right now. As soon as this video ends, I want you to look at your portfolio allocation. Calculate what percentage is denominated in dollars with no hedge against dollar weakness. If it's over 70%, you have work to do. Start with gold, allocate 10-20%. Add Bitcoin, allocate 5 to or 10%. Research foreign dividend stocks in Switzerland, Singapore, Norway, Australia. Allocate 15 to 25% of your equity holdings there. Look into farmland REITs, infrastructure ETFs, and real asset exposure. Allocate 10-15%. This isn't complicated. It's just uncomfortable. Most people won't do it because it requires admitting that the dollar might not be as safe as they've been told their entire lives. But you're not most people. You're watching this video because you want to understand what's really happening and position yourself accordingly. The wealthy have already made this move. They've diversified out of pure dollar exposure. They own global assets. They own hard assets. They own digital assets. They understand that currencies compete, and right now the dollar is losing market share. The question is, are you going to wait until everyone else figures this out, or are you going to move now while these assets are still accessible? If this video opened your eyes to the reality of dollar weakness and gave you a clear action plan for protecting your wealth, I need you to smash that like button right now. Tell the algorithm that this content matters. Tell YouTube that people need to understand what's happening to their currency and their savings. This isn't about politics. This isn't about doom and gloom. This is about reality and preparation. Leave a comment below and tell me which of these 4 asset classes you're going to implement first. Are you starting with gold? Are you buying Bitcoin? Are you researching foreign stocks? Are you looking into farmland REITs? Be honest. Tell me where you're at and what your first step is going to be. I read every single comment, and I want to know that this community is taking action. And if you haven't subscribed yet, what are you waiting for? Hit that subscribe button, become a member of this channel. We're building a community of people who understand that wealth preservation requires strategic diversification, not blind faith in a single currency. Every week, I break down investment strategies, market trends, and wealth protection tactics that you won't hear from traditional financial advisors. If you're serious about protecting what you've built, you need to be part of this community. Money doesn't care about your feelings. It doesn't care about your patriotism. It doesn't care about your loyalty to the dollar. Money only cares about the decisions you make and whether those decisions preserve purchasing power across time. The dollar is being debased. That's not an opinion. It's a fact. The question is whether you're going to protect yourself or hope the problem goes away. Now get out there and diversify strategically. Allocate to gold, allocate to Bitcoin, allocate to foreign assets, allocate to real assets. Build a portfolio that survives dollar weakness and positions you for long-term wealth preservation. This is Kevin O'Leary. Protect your wealth, make smart decisions, and I'll see you in the next video.